We appreciate all of the guests who have appeared on our show and sincerely thank them for providing you, our audience, with useful information. However, the advice our guests provide is theirs, and we encourage you to seek out a professional if you have specific questions about any topic we cover on the Crushing Debt podcast. On this week's episode of the Crushing Debt podcast, when you can't pay your mortgage.
Welcome to the Crushing Debt Podcast with your host, Florida attorney Sean Yesner, where our goal is to help you get rid of the financial bullies in your life.
So welcome back to this week's episode of the Crushing Debt Podcast. My name is Sean Yesner, owner and founder of Yesner Law, and I have a guest with me this week. But before I get to my guest, I did want to talk again about our sponsor, our friend, Sam Cohen with Attorneys First Insurance. And so if you are an attorney or title company, or if you know an attorney or title company, and you want to make sure that they are adequately protected against when mistakes can and probably will happen, that's what Sam's for. He writes errors and omissions insurance, malpractice coverage for attorneys and title companies. Now, he focuses here in Florida, but he can write anywhere in the country or almost anywhere in the country. And if you're in a place in the country where he can't write you insurance, he can either become qualified in your state or he can find you someone in your state. So if you're curious about your coverage and what it protects and what it doesn't protect and what it's good for and what it's not good for, contact Sam at attorneysfirst.com or www.attorneysfirst.com. But I want to get to my guest this week. So my guest is the owner-broker of Archer Realty, which is here locally in Palm Harbor, here in Tampa Bay. She bought her first property in 1978 and has been an investor for many years while working for IBM. She then owned various other businesses. In 2002, she became a licensed agent and opened her own brokerage in Sacramento, California in 2004. In 2007, when we had our real estate crash, she worked as a CDPE, which stands for Certified Distressed Property Expert, and I probably would have known that even if it wasn't sitting here in front of me. She's also certified SFR, which is a short sale and foreclosure resource, helping homeowners keep their home if possible. After relocating in 2014 to the Tampa area, she's considered that we may need that skill set brushed off and reused for homeowners affected by the COVID-19 pandemic and their ability to pay their mortgages. And so welcome my guest, Sue Reynolds. Welcome, Sue.
Thanks, Sean. Good to be here.
Yeah, so I will give out your information really quick. If someone wants to connect with you, it is Sue at archerrealty.us. So again, Sue at archerrealty.us. But, you know, I appreciate it. If I remember correctly, you reached out to me after listening to one of our podcast episodes here a couple of weeks ago. And based on your short sale experience and your realtor experience, had a tool that you used back in the day to help people modify their loans. And we started talking about it and decided that would be a pretty good topic for the show. So we will get there, but I want to tease the audience a little bit. So I want to sort of take us back to the beginning. So when you can't pay your mortgage, the title of the episode. So something happens, you know, we COVID-19 or we get laid off or we get divorced or we get a medical issue or whatever, and someone runs into problems paying their mortgage. What do you think is the next step after that?
Well, first of all, you know, if you're trying to keep your home, you're not going to call a realtor because their job is normally to sell the home. A lot of times you're thinking, well, I'll go talk to a loan officer and have it refinanced. But if you don't have a clear, consistent paycheck coming in, or your credit shot because you've already been late on payments, that's not the answer. And the answer is probably to first start talking to the lender you're with right now. So you have to call that number for that statement. Now, that lender, you're talking to the servicer, not the actual investor. So that's the first distinction to make. But when you call in, you're calling to talk to loss mitigation, not customer service. Customer service, their job is to get a payment, part payment, something. They want a check in the mail, and that's what they get measured on. You want to talk to loss mitigation, and those are the people that are trying to make sure that this thing does not go to foreclosure and they get that property back because they don't want it back.
Right. But I think don't most lenders are sophisticated enough these days. I mean, if you're talking about the big lenders, the big box lenders, so to speak, I think they're sophisticated enough these days. If the payment is behind, I think you'll automatically be routed to loss mitigation when you call in. I think where it's a good idea to make sure you're at loss mitigation is maybe you see the cliff coming, but you're not quite behind yet. Is that accurate?
Depends on the lender. You're right. And most loan servicers will work with multiple investors groups. So the rules, what they say to one person may be something different that they say to somebody else. But you're right. A lot of them learned their lesson from the last bout in 2007. So they immediately send you over to loss mitigation.
Right.
But you're not sure. If they start asking you for a check, then
you're not in loss mitigation. Yeah, you're not in loss mitigation. So when you get to loss mitigation, then what? So, I mean, for example, I have people that come to me and they say, I want to do a deed in lieu. But I think when you get to loss mitigation, if the first words out of your mouth are a deed in lieu, it's not going to be a very long conversation. So and we can talk about why that is, but what's the first thing that you should do when you get to loss mitigation?
Well, they're going to ask you, what you want. They want to know what the hardship is. Why can't you pay your mortgage? That's the first question that's going to be out of their mouth. Now, if you jump to the conclusion of deed in lieu, I'll tell you right now, it's an absolutely no if you have more than one mortgage on that property. Because they'll not do a deed in lieu when you've got a second or any other liens against the property.
Well, and the reason is because that's more of a title issue. That's more of a real estate law issue. And so when we say deed in lieu, what we mean is we're going to give the property back to the bank, and in exchange, the bank is going to wipe away the debt. But the problem is if the bank voluntarily takes the house back and there's a second mortgage there, that second mortgage remains. And so now you would have a first mortgage that would own the property subject to the second mortgage, where if they foreclosed, they would simply eliminate it. It wouldn't be a lien against the property. And the reason that I said, you may not want to jump directly to a deed in lieu is because I think there's a process. Like you said, if there's multiple properties, the bank wants to see, can you keep it? Can you sell it? Before the bank says, okay, we'll take it back and dig you out of this mess, there's some other options that they want to consider first.
Right. You said that very, very well. Of course, from an attorney, I expect that. They're going to want to see, is this a temporary issue that you have in paying your mortgage, or is it long-term? Is it something that maybe if we did a forbearance and we could which is what they're offering pretty easily right now, right? And you could talk to that. But if it's a forbearance, it pretty well is like freeze tag. They could say, okay, you don't have to pay for the next 6 months. And they either increase your monthly payment from then on, or they put it at the end of the loan, or different terms like that. Correct?
Yeah. And so I think the issue there, so what a lot of people don't understand is a forbearance is we, the bank, are going to forbear on taking some action because of whatever the situation is. So you lost your job due to COVID. We're going to forbear on foreclosing until there's a cure, or whatever. But the payments still accrue. So like you said, if I get a 6-month forbearance, when that 6 months is over, in month 7, I'm going to owe 7 months as a lump sum. Now, what I think a lot of the banks are going to have to do is offer some type of modification paired with that forbearance. So what they would say is, okay, the forbearance is ended, you owe 7 months worth, but let's look at a modification where we can take that 7 months and put it at the back of the loan, or take that 7 months and spread it over the next, 30 or 40 years, or, whatever it is. Much the same as the banks did when, Florida and the other coastal areas here were impacted by Hurricane Irma. They all blew through and said, okay, you were in this zone during Hurricane Irma, you get a modification. I think they're going to have to do the same thing with COVID. You took a forbearance because you're in COVID, here's your modification. And I think that's the way it's going to have to work.
Sometimes you're not at zero, right? You've got income from one spouse or another or something else. So you're not necessarily always totally at zero. So you could be saving that money that you're not paying towards the mortgage. And so they're going to look at, do you have savings? Do you have investments, other ways to pay? besides the cash flow. And then they're going to look at this just like a loan officer does. They ask you for the 2-year tax returns, the 3 months bank statements. And you essentially, when you're doing a loan mod, are providing them all the information as though you're a loan officer. And that's kind of hard. You're under stress, emotional, financial, everything else. And you're trying to do something you've never done before, which is create all this documentation of why, what you can pay, and maybe in 6 months or, forever, whatever. So then we get into the debt to income ratio, and that's where the worksheet comes in play.
Right.
Now, every one of them, if you go to their website now, they've got that process set up. They've got what you need to provide them in terms of the documentation. And they have this worksheet that's just totally mixed up. It's got all these things, like how much you pay for an insurance and how much you pay for food. And they're all kind of mixed up. And what I did was I took that and really went on the ratios that they really look at. So the first category is, what do you pay right now for your principal and interest, your mortgage? What do you pay for taxes? What do you pay for insurance? What do you pay for HOA? That's your housing expense. The next section is your personal expenses. And in that section, you've got everything, what do I pay for phone, cellular, regular home phone, internet, groceries, clothing, nights out, special school, kids' expenses, pet expenses, and everything's listed there. And if you know the right ratios, you can see what you can afford. Their number is, the magic number is, they want your personal expenses to be no more than 40% of your gross income. Now, if you're a W-2 employee, looking on your paycheck what your gross income is. If you're self-employed or something else, figuring that out might be a little harder because you pay yourself when you've got money in the account or something. I mean, people don't always formally write themselves a check every month. So figuring that out could be a little more difficult. But what they want to know is your gross income. Personal expenses are no more than 40%. They assume 29% for taxes, and then they will squeeze the home expense hopefully into 31%.
Yeah.
Now there's some acid tests on that, right?
Right. So a couple things I want to sort of unravel as we go. So one of the things you said was people can save up money while they're in forbearance, while they're not having to make their mortgage payments. They can save up money, and I totally agree, and I advise all my clients to do it. Some of them, unfortunately, are in the reality right now where they needed the dual income to survive, and so now that one spouse is no longer working, they really have no way to save. Now, if they can do that, then we can pair a forbearance with some kind of repayment plan where we say, look, we know maybe we can make, we owe 7 months, but maybe we can send you a lump sum of 5 months and then figure out how to do something with the other 2 months. And so if you're someone who's been in a fortunate enough situation that you can budget to save when you weren't making mortgage payments, maybe then you can do some type of repayment plan. The other thing that you mentioned, which I think is really important, which is I think something the Homeowner Expense Analysis Worksheet does, is it forces you to budget. And I sit with people day after day after day. And again, I'm not passing judgment. I'm not saying that this is good or bad or otherwise, but I sit with people day after day after day where I say, how much money do you have coming in? How much money do you have going out? And they don't know. And I think where the Homeowner Expense Analysis Worksheet helps is to even help people budget at the very beginning to say, okay, here's where my money's coming in, here's where it's going out. And it may even help them in certain situations to adjust some of the income, some of the expenses, so that they have more money, so that they can afford the modification, or they can afford to save up some money, or whatever the situation may be. And so and so what we're talking about, what Sue did was she created a document that she calls the Homeowner Expense Analysis Worksheet. And it's a tool that we hope the banks can use But if not the banks, at least the borrowers can use to say, here's where the bank's numbers are. Like you said, the 31% for the mortgage payment, 40% for the other payments, 20-something% for taxes. And we can sort of guess right up front if we plug the numbers into the worksheet and the numbers come back and say, you had $1,000 mortgage payment and the best we can do on a modification is $300. We know up front that modification's never going to work. We got to find another alternative. And I think the reverse is true. If you have $1,000 mortgage payment and we use the expense analysis worksheet and it says best we can do on a modification is $1,800 a month because you're making so much money, I don't think a modification is going to work in that scenario either.
Right. There's some basic acid tests for it. The problem is that when somebody sees the numbers, then they go, okay, well, I'll just make my numbers work. But the bank statements have to substantiate what you're saying.
Right.
They have to see the deposits in the bank statements that show the gross income well, that's the net normally that shows up in there. But it's got to be able to see the income coming in and the deposits, and it's got to see what your real expenses are. When it sees other expenses coming in there that you haven't reported on that worksheet, it doesn't work.
Right.
Numbers aren't going to come together.
Yeah, don't make up the numbers.
We had a lot of last time was a lot of people kept saying, well, they told me they were going to approve me and I've sent my numbers in. It's like, if the worksheet doesn't work, the worksheet doesn't work. So why are you wasting a year, 2 years down the road still arguing with the lender and having them send more paperwork, and it's just not going to work. So,
well, and I get it. People are frustrated because, it's not their fault that we got COVID. It's not their fault that the market crashed, but now they're subject to these outside forces that are impacting whether they can afford their home or not. And so I'm sympathetic to the homeowners that say, through no control of my own, I got a divorce. I found out I have cancer. This, that, the other happened. I get that. But I think where people need to focus here is, what do the numbers say? Is it realistic to keep my home? And then that's where we come in to say, okay, maybe it's not realistic to keep your home. Let's look at a short sale. Let's look at a deed in lieu. Let's look at a bankruptcy. Let's look at something else that will help you.
What's important is if you understand where your numbers are, then you can look at alternatives like, what about renting a room? You may not want to do that. You don't want anybody else living with you. But if you really wanted to keep your house, it's either increase your income or decrease your expenses.
Right.
It's the only two things you can do. You can keep wasting your time sending them more paperwork and them coming back and saying they're doing an analysis. And in the end, it's just not going to work. Now, some of the problems we had the last time, and we kind of talked about some of the horror stories, you get a realtor that gets referred your home as a short sale, and then you come back and you find that you could have actually done a loan modification. If people had seen the worksheet and understood that it should be able to work, or you're just sending the paperwork up for a year or 2 years and they keep sending you the foreclosure notices. Do you really want to go through that stress and aggravation for it? Because while you're doing that, your credit score is going in the tank. And if you have to find alternative housing and you need to show your credit score for a potential landlord, what are you going to do?
Yeah.
So, this is advanced subject, Sean, we didn't talk about the other day, but what about selling the house before it gets to short sale, or maybe even as a short sale, but assuming the loan? Then they can help improve your credit
right.
at the same time. That's really but having the worksheet, I was trying to get the lenders to take that worksheet as part of the paperwork they required a homeowner to do so they could see where their numbers really were. Were
right.
they ever going to be able to qualify for a loan mod? I had an elderly gentleman who he had not been paying his mortgage and he owed a lot of money. So they did a preliminary approval, and it was actually about 65% of his gross income. And so I explained to him, you understand, they're just trying to see what money you have before you run out of money, and then they're going to end up declining your application anyway. They're just trying to get as much as they can out of the situation. And with the worksheet, you kind of know where the playing field is.
Yeah. And so I do want to say Sue created the worksheet and I think it's tremendous. I mean, I've promoted certain things as budgets over the course of the career of the podcast, but I think the worksheet is tremendous. And so Sue created it. I want to give her all the credit and all the accolades for creating it. However, she sent it to me, and she is allowing me to give it to all of you. So if you are interested in seeing this worksheet, I'm going to set up a website, SeanMYesner.com/expense worksheet. So those of you that have been listening for a while know that I've got SeanMYesner.com/become debt free, which is my second book, Become Debt Free in Less Than an Hour. I've also got SeanMYesner.com/subscribe. So if you're interested in subscribing, although if you're already listening to the show, you know how to listen and you know how to subscribe, you probably don't need to go to that website. But I will set up before this episode releases, SeanMYesner.com/expense worksheet. And so probably be a website where you give me your email, and in exchange, I'll send you a copy of Sue's worksheet, so you can incorporate it into your budget, or you can incorporate it into if you're having issues with a loan modification or short sale or whatever the scenario. And I totally agree, Sue, that I've said I don't think we're going to see the level of short sales that we saw from 08 to 14, but I do think we're going to see a lot of sales. And I think a lot of houses today have equity where a lot of houses in the recession didn't. But I still think we are going to see some level of short sales. I think that's the only way that we're going to get out of this mess. But I think real estate may be leading the charge to pull us out of this recession where it caused the last one. So, again, if you want to pick up a copy of that, the Homeowner Expense Analysis Worksheet, go to SeanMYesner.com/expense worksheet. Anything else, Sue, that you wanted to add, or anything that I might have missed?
No, actually, it does nothing more. The worksheet does nothing more than take all of the line items that your lender's asking you and reorganizing them with that analysis of 31% for housing expense, 40% for personal, and 29% towards taxes and things. But yeah, we don't know where this market's going to go, but we all need to at least be more educated on the budget and make sure we're staying within our means.
Yeah. And I think that's the point. That's the entire point of today's episode. And so again, I think the worksheet is a tremendous tool if you want to analyze where do you stand in terms of a loan modification. Some of the stuff I've got under Become Debt Free are great tools in terms of budgeting and doing that kind of stuff and combining the two. But yeah, I mean, I wouldn't be promoting the worksheet and I wouldn't be thanking you if I didn't think it was a useful tool for everyone to use. And thank you for allowing our listeners to have access to it.
Oh, you're more than welcome. I think we all need to just kind of tighten our belts and figure out how to get through all this right now.
And socially distance and wash your hands.
And wear the masks or what?
And wear the masks and do whatever. So, well, cool. I appreciate it. I think that'll probably do it for this week's episode of the podcast. Again, if you want to contact Sue, it is sue@archerrealty.us. I'll have that in the notes. If you want a copy of the worksheet, SeanMYesner.com/expense worksheet. But, like I say at the end of every month, and what the worksheet I think is designed to do is to make sure that you have more money at the end of the month and not more month at the end of the money. So thank you again, Sue, for reaching out and for suggesting this topic and for giving me the worksheet and for being a guest on the show.
My pleasure. Absolutely.
So we will catch you thank you for listening to this week's episode of the Crushing Debt Podcast, and we will catch you in next week's episode.
If you have questions that you think would make a great topic for a future episode, please email Sean or connect with us on social media. Sean Yesner and Yesner Law, PL, are Florida licensed attorneys. The information contained in this week's episode is not a substitute for legal advice. Your situation may differ, especially if you are located somewhere other than the state of Florida. If you have questions, please contact our office or contact a local attorney. Thank you for listening to this week's episode of the Crushing Debt Podcast.